Reuters.
It began quietly enough as a downturn in the once booming U.S. housing market. Now it has snowballed into what may be the biggest financial crisis since the Great Depression. The global credit crunch it spawned has now forced some of Wall Street's most swashbuckling firms to their knees and embroiled Washington in a race to head off economic calamity. Harvard Business School professor emeritus Samuel Hayes.
It is an historic event, and I think it really ranks with changes that we saw in the 1930s in some dimensions.
It all starts with ultra-cheap mortgage loans to borrowers with weak credit histories, dubbed in the market as subprime. Those loans, millions of them, inflate the housing bubble. Then defaults begin to spike. That chokes banks, so lenders become stingy. Soon, the first big domino falls. In April '07, the third largest U.S. subprime lender, New Century Financial, files for bankruptcy. The flu then spreads to bigger institutions, which begin to report huge losses. They're burdened with complex subprime-backed securities now plummeting in value. In September, a scene reminiscent of the Depression, a run on a British mortgage lender. A few days later, the Federal Reserve makes the first of 7 interest rate cuts.
50,000 trades at 8, your bid.
But a month later, investors turn tail. The Dow has since lost more than a fifth of its value. At the same time, a new and unregulated market is emerging intended to help insure lenders against bad loans. But these derivatives, including credit default swaps, are becoming nearly impossible to value and are weighing down major players. The slump speeds up as consumers get socked with high gas prices and falling home values. In February of this year, President George Bush signs a $152 billion stimulus package to try to skirt a recession. But in March, the credit crunch claims its first big Wall Street victim. The Federal Reserve makes a surprising move, engineering the sale of Bear Stearns to J.P. Morgan Chase. Then, in September, the titans topple like dominoes. Within 2 weeks, the Fed bails out mortgage giants Freddie Mac and Fannie Mae and insurer AIG. But it gives a cold shoulder to Lehman Brothers, which then files for bankruptcy. Merrill Lynch avoids Lehman's fate by getting into a shotgun marriage with Bank of America. With their stocks under siege, Goldman Sachs and Morgan Stanley agree to become bank holding companies. The Fed and Treasury respond with a $700 billion bailout plan. Professor Osgur Demirtas teaches finance at the Zicklin School of Business.
If nothing is done in U.S. To correct what we are in right now, when the U.S. financial system is in a bigger crisis, when there is no more lending of the money, Main Street in U.S. will be affected. But when the Main Street in U.S. is affected, the same way the financial sector is customers to each other, Main Street is customers to other countries' Main Street, which means that there's going to be less exports for China, and there's going to be less exports for U.S. too.
And in China, thousands of panicked depositors lined up Wednesday to pull funds out of a bank. Another sign of the global impact of a problem homegrown. Fred Katayama, Reuters, New York.